Hi, welcome back to Concierge CPA. I am Juliet. In this video, we are continuing our discussion on adjusting journal entries, also known as AJEs. These are the entries made at the end of the accounting period to ensure your financial statements reflect the correct timing of revenues, expenses, and changes in asset balances. In part 1 of this series, we covered the 5 most common adjusting entries that deal with the timing of revenue and expenses. Entries like accrued expenses, prepaid expenses, and unearned revenue. In this video, we are focusing on the less commonly known adjusting entries, the ones that don't always show up in every business, but when they do, they are very important. These entries are critical for maintaining accurate asset balances, estimating future losses, and ensuring your financial statements aren't missing key adjustments. Just like before, all of these entries are part of the step 6 of the accounting cycle, the point where you make end-of-period adjustments before preparing financial statements. If you need a refresher on the full cycle, I've linked my accounting cycle video in the description below. Today, we're going to cover 4 often overlooked adjusting entries: depreciation, bad debt expense using the allowance method, supplies adjustments, inventory adjustments, and shrinkage. Let's begin with depreciation, the entry that systematically reduces the book value of long-term assets over time. Depreciation spreads the cost of an asset over the period it helps generate revenues. It's a non-cash expense that follows the matching principle, ensuring we recognize the expense in the same period the asset is used. Now, there are several methods used to calculate depreciation, including straight line, declining balance, and units of production. In this video, we'll focus on the straight line method, which is the simplest and most commonly used. I'll explain the other methods in a separate video, which I will link in the description when it's live. Here's how it works. Let's say your business purchases a piece of equipment on July 1st for $13,000, and it has a useful life of 4 years. At the end of those 4 years, you estimate that you'll be able to sell or scrap it for $1,000. That $1,000 is called the salvage value, the expected residual value of the asset once its useful life is over. To calculate monthly depreciation using the straight line method, subtract the salvage value from the asset's cost and divide the results by the asset's useful life in months. $13,000 minus 1,000 divided by 48 months equals $250 of depreciation every month. So each month you will record the following adjusting journal entry. You will debit depreciation expense for $250 and you would credit accumulated depreciation for $250. This spreads the cost of the asset less the amount you expect to recover at the end over the periods the asset is being used, keeping your financial statements accurate and in line with accrual accounting principles. This is a crucial adjusting journal entry because it ensures your books reflect the current asset value and the expense tied to using that asset during the period. Without this adjusting journal entry, both your income statement and balance sheet would be incomplete and inaccurate. Now let's move on to the next lesser known but incredibly important adjusting entry: bad debt expense using the allowance method. Here's the reality. Not all customers are going to pay you back. I know, shocking. You can send reminders, follow up with emails, maybe even a friendly just checking in call, but sometimes invoices go unpaid. To reflect that reality, we make an adjusting entry to estimate how much of our receivables may not be collected. In accrual accounting, we don't wait until an account officially goes bad to recognize the loss. Instead, we estimate in advance how much of our receivables might never be collected and record bad debt expense in the same period the related revenue was recognized. This is known as the allowance method, and it's the GAAP-approved way of handling bad debts. It follows the matching principle, ensuring expenses are aligned with the revenues they helped generate. Let's go through a quick example. Say your business has $100,000 in accounts receivable at the end of the period. Based on past experience, you estimate that 2% of that might go uncollected. That's $2,000 in potential losses. Here's the adjusting entry you'll make at the end of the period. You would debit bad debt expense for $2,000 and you would credit allowance for doubtful accounts for $2,000. This entry doesn't write off a specific customer's balance, yet it just creates a buffer on the balance sheet in case some invoices go unpaid later. Then, when a specific account is confirmed as uncollectible, you will reduce both the allowance and accounts receivable with a separate entry. This adjusting entry is crucial because it helps paint a more realistic picture of your receivables, prevents overstating assets, and keeps your income statement honest. Here's some bonus information to quickly review how the allowance for doubtful accounts is presented on the balance sheet. The allowance for doubtful accounts is what we call a contra asset account, which means it's paired with and reduces the balance of another asset account, in this case, accounts receivable. Instead of reporting the total amount customers owe you, the balance sheet shows the net realizable value, what you actually expect to collect. So on the balance sheet, it's presented like this. Accounts receivable $100,000 less allowance for doubtful accounts of $2,000. The net accounts receivable is $98,000. This keeps your financials realistic and conservative because not every dollar of receivables will come through, and you don't want to overstate your assets. The allowance account carries a credit balance, which offsets the debit balance in accounts receivable. It's an essential part of accrual accounting, ensuring the financial statements reflect potential losses even before they actually happen. This is a crucial adjusting journal entry because it ensures your books reflect the true collectible value of your receivables and the associated expense of potential credit losses. Without this adjusting journal entry, your balance sheet will overstate assets and your income statement wouldn't capture the cost of doing business on credit, leaving your financials both incomplete and misleading. Now let's move on to the next essential but often overlooked adjusting journal entry: supplies adjustments. This one comes into play when a business purchases a large batch of supplies upfront and records the whole cost as an asset, typically a supplies account. But by the end of the period, some of those supplies have been used up. Printer ink, shipping materials, coffee filters in the break room. Yes, those count too. If we don't adjust for what's been used, we will be overstating our assets and understating our expenses. So we do a physical count of what's left, subtract that from what we started with, and record the difference as supplies expense. For example, if supplies has a beginning balance of $1,500 and the ending, which is what's on hand, it's $600, we have used $900 of supplies. So we book an adjusting journal entry. We debit supplies expense for $900 and we credit the supplies asset account for $900. This adjusting journal entry makes sure the income statement reflects the cost of supplies actually used, and the balance sheet only shows what's still on hand, keeping both statements clean and accurate. All right, let's wrap this up with the final adjusting entry: inventory. Here's the deal. If you're using the periodic inventory system, you don't record cost of goods sold as you go. Instead, you wait until the end of the period. Physically count your inventory and back into cost of goods sold using this formula. Beginning inventory plus purchases minus ending inventory equals your cost of goods sold for the period. So that physical inventory count isn't just about tidying up your shelves. It's essential for calculating how much it actually costs you to sell your products during the period. But let's keep it real. Sometimes the numbers don't just reflect what you sold. They can also include shrinkage, things like theft, spoilage, breakage, or even simple bookkeeping errors. That means your cost of goods sold might be a combination of real sales activity plus a little behind the scenes loss. So when you record this adjusting journal entry, you're not just updating inventory, you're telling the full story of what left the building, sold or unsold. This entry is vital to get your gross profit right and to avoid overstating inventory on the balance sheet. And here's a fact. Even if your business uses a perpetual inventory system with real-time updates using FIFO or LIFO, you can and should still do a physical count to adjust for shrinkage. Perpetual systems know what should be there, not what actually is. This adjusting journal entry is still applicable for perpetual systems. So there you have it, 4 crucial adjusting entries that might not show up in every business, but when they do, they are absolutely essential for accurate financial reporting. These entries ensure your financial statements paint a complete and accurate picture of your business's financial position. Depreciation entries that spread asset costs over their usual lives, bad debt expense using the allowance method to account for uncollectible receivables, supplies adjustments to reflect what's actually being used, and inventory adjustments to capture shrinkage and calculate accurate cost of goods sold. If you found this helpful, give this video a thumbs up and subscribe for more accounting insights. Don't forget to check our part 1 of this series if you haven't already. I have linked it in the description along with my comprehensive accounting cycle video below. Got questions about any of these adjusted entries? Drop them in the comments below. I read every single one and love helping you work through accounting challenges. Thanks for watching and I'll see you in the next video.